All right, hello everyone. So, welcome to this video here. We're going to talk about the order types that we're going to be seeing at TD Direct Investing. Their platform is called Webbroker. This is actually not just specific to Webbroker. This could be used for any of the actual brokerage sites. So, whatever you're using out there. Here, I'm talking in Canada right now, but this is also applicable to the States as well. They have very similar ones. The TD equivalent there, which is a little bit more performant, is the Ameritrade platform. But on the Canadian side, we do have the Questrade, we have the interactive brokers, and so forth. So let's go ahead and get started. The first order type that I'm going to talk about is the market. So I've also placed the screenshot on the right here, obviously to hide like all the numbers and stuff. I've only kind of taken a picture of the actual thing here. So the reason why I know all these order types is that I used to work in this department, as well as I have been investing for upwards of 7 years now and work in the investment industry. The first one is called a market order that I'm going to be talking about. If you guys don't know how to get to this page, it is your first time using Webbroker, I will make a separate video on that. I'll link it here. But if you guys don't know, once you are logging in, you just click the buy/sell button at the top right corner of the screen on your Webbroker, and it'll bring you up to here. So the four kind of things there at the top: stocks, ETFs, option strategy, mutual fund. We're not going to go into that right now. We're just going to go to the default one, which is your stocks and ETFs button, and we're just going to pay attention to the price type that you guys see over here. Price type. And we're just going to talk about all the different ones, okay? The first one is the market order. So the market order prioritizes speed, and it's the best available price at the time. So I've also kind of put some information here at the left side of the screen for you guys. Basically, this is what would be going on in your inner dialogue or the decision, or if you are talking to, let's say, a real broker like you would back in the day, or that's still used now. This is kind of how you would be speaking to them to formulate your decision. So a market order, I'm going to be giving you guys an example of a $50 stock. Assumed $50 stock. For the other examples in the market order, there's no point in giving you guys a number because it does not matter. The entire point of a market order is that you want this stock to buy or to sell it, or any other security, at whatever price is available, best price that is available at the moment that you are placing the order. Okay, so let's say you want, I don't know, Bell Canada, you want Royal Bank, you want one of these stocks, and you don't care what price you're getting them at. You don't really want to bid, you don't want to really bid or for these stocks or wait. You just want them. You want 100 shares, and that's it. You just want to set it and forget it. This is usually when you put the market. Most of the time, you're going to be using the market order if you are buying and holding, because you're most likely holding these for a very long time. You don't really care about a couple, cents here and there, or waiting a few days to get in. You just know you want to get in, doesn't matter, and it'll go higher. If you're shorting, it'll go lower. So you're getting it at whatever price you want and holding it for probably a long time. Or you're trading, day trading really, really long spreads, large spreads, but that usually doesn't, even then you'd be placing one of the other orders that I'll get in. So the thought behind this is, give me these shares at the best available price at the moment I place the trade. Okay, let's go on to the next one. So the market order is the most common one. Also, it's the default one. The more popular one, the less popular one, but just used a lot, is called the limit order. Okay, so this is actually when you're setting a price that you want to be filled at, and a fill means a buy or a sell. So let's say that you want to, the stock is right now, let's say $53, and you want it at $50. Okay, you will be setting the price, the limit price over here at $50. Okay, now if the stock goes to $50, it'll fill you at whatever quantity you put. I've circled limit price there. The quantity is above that. Okay, so It buys or sells at a specific price and it's always visible to the market. So why am I saying it's always visible to the market? I'm not going to get into that just yet. I'll get into that in the next order, but you'll see why that's a difference. It prioritizes accuracy. And what you're really doing is, let's say you're saying to the broker, wait till $50, then fill me at that price or better. Okay, so the keyword is also better. If let's say you want to buy at $50, it is now 53. The stock came crashing down, you know, Trump tweeted something or some crazy market fluctuation. It'll go down all the way to 50, okay? And that's when it's gonna start filling you. That's the keyword, start filling you. If the price is going down more and more and people are sending sells for more and more, let's say you want 1,000 shares, right? But someone only put to sell you 100 shares at $50, then where you need that 900 for somewhere else. Maybe someone else is selling the 900 at $49.90, right? You'll get an even better price than $50, okay? All right, so now that I've made that clear, the next one, this is gonna be a little bit more confusing, but please stay with me, is the stop market, okay? So the stop market is a lot like the limit price. However, you are taking your chances. So the easiest way I can explain this is that you guys already know what a market order is. I just told you before. Basically, you are setting a price called the trigger price, at which the order becomes a market order. Okay, so this is like setting a limit. When do you want to stop? When do you want it to trigger and actually start filling you on the buy or the sell? So what does that actually mean, and how is that different from the limit? Because Mike, you just told me that if I set a limit, it's gonna fill me at that price. There's a big difference. Okay, so a limit, let's say that same stock that's at $53 goes all the way to 50, and you put your trigger price at 50. What happens now is it becomes a market order. So now, what is a market order? A market order is is when it fills you at the best available price. So if it's saying that you want to trigger this at $50, no matter where the price goes afterwards, it's going to be filling you. So what does that actually mean? I'm going to stick with an example on the buy, and you guys can just, and I'll also give you an example on the sell, but it's just the opposite of the buy, right? So let's say we want to buy a stock with a trigger price, stop market at $50. The price goes from 53 to 50. It'll start filling you, but then let's say something great happened, right? They got, $1 million all of a sudden, and the price shoots to 55 right away. It's going to fill you whatever it can at 50 when it hits, and then it's going to keep filling you if it goes up or if it goes down. Okay, so the difference is on the limit price. If it dips down to $50 on the other order, let me just go back to that one for a sec. If it goes to 50, it's then going to start filling you, and if it goes back up, it's not going to fill you anymore. It's only going to keep filling you if it keeps coming back down, because you have that hard limit in place. The stop market is not visible to the market until there is a trigger price. Okay, so let's move on to the stop limits. So it was important that we first talk about those two things so that we can go into the stop limit. So a stop limit it becomes a market order at a trigger price, but up to a limit. So this is when you're getting very, very specific here. So I'll start off with an example, and then I'll move into actually how it works. So let's say you have the trigger price on one end and you're doing the limit price on one end. Again, I'm going to be talking about a buy example, okay? So when you are buying, let's say that we have the same stock at $53, okay? The $53, then you set a trigger price at 50, and then you would set a limit price, let's say at you can set it higher or lower. Let's say we'll set it higher at 55. Okay, so this kind of stops that crazy violent swing that could happen with a stop market order. So in the previous example, I gave you the example that let's say it goes down to $50. and then becomes a market order, but then this shoots back up to 55.60, okay? Right? So if we set a limit price, let's say at 55, we don't want to buy any more at 55 unless, you know, the quantity is filled up until the 55. Then it'll stop filling you and it'll give you whatever, right? So let's say you want to buy 1,000 shares and you set a trigger price at 50 and a limit price of 55. It is now $53. If it goes down to 50, it becomes a market order and it'll start filling you. When let's say it starts going back up, right? You buy 150, 152, 153, 200 at 54, and then it hits 55 and you get another 100 or so, right? So that, I didn't actually keep up with how much I was saying. Around 500, 600 shares, it'll stop filling you there, and the other 400 shares, you won't get filled on as it keeps increasing. So you'd have to set, again, another order for you to get those other 400 shares if you'd like them. You could set any other order you want, limit, market, and so forth. So what is this? It's effectively a range with the trigger price being the floor and the limit price being the ceiling. On the sell side, of course, you want to go the other way because you want to sell for higher, right? You want to buy lower, you want to sell higher. And that's hopefully, right? We want to use that mentality to make a little bit of money here, at least not lose it, right? Okay, so now that we've got that settled, we're gonna go on to the final things, which are the trailing orders. So there's trailing stop limit and trailing stop market, but I'm just gonna say what a trailing order is because it doesn't really make sense for me to talk about a trailing stop market and a trailing stop limit because it's already kind of explained in the other ones. A stop market is going to stay exactly the same, and a stop limit is going to stay exactly the same when we're adding the word trailing in front of it. So this is a little bit more this is the very not often used because you have to really understand what you're doing with this one. So but it can be used very, very effectively, and it's not that difficult to understand for protecting your gains, okay? So in this example, I'm actually going to be switching it up and telling you guys on a sell, okay? So let's say we're going to be selling. Now let's talk about what a trigger delta is. So this is exactly the same as the limit. So this would be a trailing stop limit. This is exactly the same as a stop limit. You're setting a trigger and a limit, okay? For you to stop getting filled, for you to start getting filled at one price and stop getting filled at another one. Now, obviously, if it's going the other way around, you're going to be filled at a better price, right? So this is why we're setting a limit in one way, not both ways, right? It's not an option, so we're not trying to swing two different ways here. We can't do that. So basically, a trigger delta, what it means is you can go by dollar and you can go by percent. Okay. So I'll give you an example in terms of a percent, because usually when we are investing, we want to set a discipline for ourselves. We don't want to lose more than, let's say, 20%, or we want to take profits at, like, let's say 20% the other way, okay? This can be different for everybody's risk profile and risk appetite and what you're trying to achieve, right? Let's say you want to sell on the lower side if you are losing more than 20%, but don't want to sell on the gaining side if you are making more than up until you're making more than 40%. After that, you want to take your profits because you want to realize them and put them into another security, or you want to take them out and achieve the goal that you were trying to achieve in the first place, more savings, a different asset, and so forth. Okay, so let's give you guys an example. If the stock I own starts losing 20% from its highest point, start selling it. If it reaches 40% from its highest point, stop selling it. I don't want to take that. I want to take the chance that it's going to go back up a little bit. Okay. So how do we actually change between the dollar sign and the percent sign? On Webbroker, you can just click the dollar sign right here when you go to a trailing stop, and you can change it between percentage and dollar. Okay, so how does this actually work? It trails the order, right? So let's say that, and it always goes to the highest point. So let's say we're trying to sell a stock and we wanted to sell, when it reaches 20% below its highest trading price. So if this stock keeps increasing, it will never sell. Let's say it's $50, it goes to $51, $52, $53, $54. It's not going to sell. But let's say now that it goes to $55. At that point, some crazy catastrophic news comes out, and the stock starts falling rapidly, and it falls 20% from that price. Okay, that's going to hit your trigger delta, and let's assume it keeps falling to 40%. It's going to fill you between that 20 and 40%. So there's that floor and ceiling we're talking about. Obviously, because we're selling, we're switching the floor and the ceiling because we want to sell it as high as possible, right? We don't want a low ceiling, right? A low floor. So if the stock keeps going from 20 to 40%, as it's going down, it's going to keep filling you. If you're lucky enough to get filled between, you know, let's say right at 20% or between 20 and 25%, great. But if you're not, you know, if the stock is tanking and everyone's like setting even lower prices, and it reaches below the 40% and you didn't sell the quantity that you wanted to, it's going to stop at that point, and you're basically assuming to take your chances. Okay. So those are all the order types I have for you guys today. Those are all the order types you're ever going to need. But finally, just a word, because I know that the biggest one is going to be the stop market and stop limit. Why? I always get this question: why would I ever put a stop market if a limit price is going to fill me at the price that I want, right? So again, a stop market, when you're going to that specific price, the trigger, it's going to start filling you no matter which way it jumps. If it's a limit, it's going to fill you at that price or better. But if it jumps up higher or lower, if you're selling, it's not going to fill you anymore, right? So it's going to wait until it goes back to the limit price, and you don't have to keep adjusting it. It's going to fluctuate, and as long as it's hitting that limit price and filling your quantity, you're set to go. Okay, so why would you ever put a stop market if you're going to be filled at whatever price or better? The answer is risk, right? So maybe this doesn't work for a blue chip stock. A blue chip stock is a very high capitalized stock. But let's say you guys are dealing with lower volume, lower price securities under $3. This is where risk comes into place, and this is where most of these strategies comes into place, that you want to take your chances that even if it does go up, you're going to be filling yourself at whatever price is available. So really what you're trying to do here is set a limit to start buying, and then taking your chances afterwards, but you're hoping that you're going to be filled very close to that price and as quick as possible, and all of your quantity. Whereas a limit, you want that specific price, no matter what, you're willing to forgo some of the quantity if necessary. Okay, so just a quick word on that. Now, that's all I have for you guys today. If you guys are still confused, I know I would be. It takes more than 12 minutes just to do this, and of course, if you probably would need more examples and stuff like that. Please comment below. Make sure to like, subscribe, and if you do like these videos and you do want to actually get notified without having to log into YouTube all the time and get it to your phone, click that bell notification, and I'll put out some more financial videos for you guys. Let me know what you guys like. Maybe more investment videos, maybe passive income, maybe financial independence videos. Okay, all right, thank you so much.